Alright, so this is part 2 of the video on what will trigger the next bull market. If you've not watched part 1, be sure to pause this video, go watch part 1, get up to speed, and then we'll continue from here. If you've watched part 1, great, let's continue. Now, this is the S&P 500, and you can see that year to date, it has fallen all the way down to 24.5% from the peak, but it has bounced back slightly since then, and we are down like 20% from the peak. So where will the market end up by the end of this year? To me, there are 4 scenarios, and I'm going to tell you how these 4 scenarios could play out. The first scenario is that the market in the second half of the year will bounce all the way back to its all-time highs. Now, some of you are looking at me and saying, really? Well, that's just one scenario. So in that scenario, let's call that scenario number 1. It means that for the whole of 2022, market went nowhere. Zero return for the year. Now, that is scenario number 1. Scenario number 2 is the market will rebound in the second half, but not back to all-time highs yet. It will go to maybe about 4,335, which is 10% fall from the peak, which means for 2022 we're down 10%. This is the second scenario. The third scenario is that the market for the next 6 months goes nowhere. It just goes up, down, up, down, up, down, up, down, up, down. By the end of the year, it ends up where it is today, which means by the end of the year, it's down 24.5%. And that's scenario number 3. Scenario number 4, which is what the biggest bears are saying, is that, you know what, it's going to go down all the way to an average bear market bottom, which is about 35%. Average bear market is about 35%. So if that goes all the way down here, okay, scenario number 4, we're looking at 35% drop for the whole of this year. Now, if the Fed stops raising interest rates from here because inflation starts coming down, and if there's no recession, then we're looking at scenario number 1. In other words, the market will rebound back to all-time highs by the end of the year. That's scenario number 1. Scenario number 2 is this. If we get a mild recession, then likely we're going to rally all the way up back to here, and we end up down 10% for the year. If we end up to have a severe recession, then the market will probably end up where it is right now, because the market, after moving down 24%, has really priced in a recession. It's really assumed a recession. Okay. Now, of course, if we get a really bad collapse like financial crisis, dot-com crash, then the market will drop down to 35% or even 50%. So what's the likely scenario? Let's take a look at the next table. All right, so in this table, you can see the relationship between the S&P 500 price changes to the manufacturing PMI, or Purchasing Managers Index. The manufacturing PMI is a reflection of the economic activity. Now, generally, if you look at the history, they tend to move together. Usually, the market goes down, then the economic activity will follow. Market goes up, economic activity will follow, because the market prices in the future. The market moves ahead of the economy by about 6 months, okay? So based on where the market has moved, where must the economy move to prove the market right or wrong? Now let's take a look right here, okay? So we can see that the red line is the S&P 500, and the market has already dropped. Can you see the red line has already dropped? But the actual economic activity has not dropped as much. So the market, again, has really priced in a worse scenario. And now we have to see whether the economy will end up proving the market right. Now, currently, economic activity has fallen. It was at 66, the PMI. As of yesterday, all right, 2 days ago, sorry, it dropped to 53. So we already have a slowdown in economic activity, but it is still above 50. Anything below 50 means economic activity contracting, which means possible recession, right? And the bigger the drop, the more severe the contraction, the more severe the recession. Now, the stock market has already dropped 25%. Well, it's 24.5%, but let's round it off to 25%, right? Okay. So if the market stays at this level by the end of the year, that means that the economy will have to go into a recession, a severe recession, and PMI has to contract to 42, which is the level it was at during the dot-com crash. So what does it mean? That means to say if we go into a severe recession, then the market should stay where it is by the end of the year because the market is really priced in this severe recession. But if we don't get a severe recession, if we get a mild recession where the PMI is around here. Now, usually in a mild recession, the PMI will drop to about 46. Okay, so in that case, then the market should fall 10%, right? This is 10% over here. By the end of the year, the market should be down 10%, which means that from where we are now, the market should rally back up to 10% below the high, which is scenario number 2. If we get no recession, then economic activity doesn't go below 50, and that implies that the market will rally back to all-time highs to end up 0% gain for 2022. If we get a disaster crash, the likes of the great financial crisis, which like I say, I don't see from the economic data, but if we get that, then the market could drop down to 35% below the peak to 50% below the peak. So from this chart, let's go back to the S&P 500. So again, scenario number 1 over here is we don't get a recession. By the end of the year, we'll rally back to the top. Scenario number 2, we get a mild recession and the market will rally back to here. So we still end up down, but down 10% and not down as much as where we are today, right? Now, if we get a bad recession, then the market will chop around and stay at 25%, which is the current low that we reached last week, right? If scenario number 4, we get financial crisis, great recession kind of thing, then sure, we could go down to minus 35% from the peak or even down minus 50% from the peak. My take is I'm looking at scenario number 2 is the closest scenario, but I will not rule out scenario number 1. We could still have number 1, but I'm probably looking by the end of the year, we're going to rally back to 10% from the peak to 5% from the peak to even breaking even by the end of the year. So all we need is that spark. We just need inflation to come down. We just need economic data to show that, hey, it's not as bad as everyone thinks, and that will light a huge explosive bull market. So why? Because currently the market is so oversold. There's so much cash on the sidelines, like a lot of dry wood, a lot of dry timber, right? The moment you get a spark, boom, you get a huge rally. Because the market, like I said, is way oversold. Take a look at the asset manager positioning of all equity futures. And you can see that right now it's at record lows, which means the majority of asset managers have already gone out of the market. They're holding a lot of cash or they even net short the market. So every time this is at all-time lows, it has always marked previous bear market bottoms. And right now we're at a historic low. Again, it's kind of like that rubber band effect, right? When you pull it too much one way, it's gonna snap back the other way. Retail investors are also extremely bearish, and again, one of the most bearish in recent history. As of the 20th of June, the bull-bear ratio is at 0.82. So a lot more bears than bulls. And you can see that every time historically, this bull-bear ratio goes below 1 and it goes very far below 1, this has marked bottoms in the market, and this has led to explosive bull markets that followed thereafter. So again, that rubber band effect is going lower and lower. Extreme fear, right? The fear and greed index has been at extreme fear for quite a while and it's going to explode eventually. Before we move on to the next part of this video, I've got exciting news and announcement. I'll be conducting a free live online event for all my viewers really soon, where I'll go into detail on how I identify and analyze the best stocks in the market that will survive this uncertainty and help you to profit from the rebound. I'll also teach you how to develop the psychology of a winning investor and show you my ultimate investors watch list of stocks that's going to lead the next bull market. So registration is opening really soon. Seats are very limited. Click on the link in the description right now to be placed on our event priority list, and my team will send you an email invite really soon. So I look forward to seeing you at the event. Now on to the rest of the video. There are two cycles that make this year really interesting. So first, we look at the 4-year presidential cycle. So this year, 2022, is the second year of Biden's term. And you can see that historically, during a second year of any president's term, the market tends to sell off the first half of the year or even the first 3 quarters of the year. But the end of the year, it tends to rally back and make back all the losses, or at least half the losses. And again, this is the 4-year presidential cycle. If you take a look at the decennial pattern, same thing which I mentioned, all years ending with 2, they tend to sell off for the first 6 months or even the first 9 months and rally back the last 3 months. Now again, we can't predict the future for certain. I keep saying that no one knows the future. But again, if you look at cycles, you look at patterns, you look at economic data, you look at sentiment, everything points to a huge second half bull market rally. But always remember, there's no 100% in the market. We can't predict for certain. We can only look at probabilities. And all I can tell you now is that there's a high probability the market will end up higher than lower for the second half of the year. Now, finally, let me just show you this chart. And on my cover slide, I said that bull market, the next bull market is going to trigger a 4.8x gain. Okay, so what do I mean by that? Now, currently we are in a bear market, and I think for a lot of people, it doesn't feel comfortable seeing your portfolio go down for 5-6 months, right? But remember that for those people who can stay the course, who can go through this pain, I call it pain because I don't really feel pain psychological, but if you can go through this so-called pain that people go through, you're going to be richly rewarded. So again, if you take a look at history, you can see that the history of all the bull and bear markets in the last 70 years, the average bear market was minus 34.6%, or about minus 35%. The average bull market was 166.2%. So that means the average bull market, you take 166 divided by 34, you get 4.8 times. In other words, for every 1% drop in the bear market, you expect a 4.8% bounce in the bull market. And that's the reward for going through this bear market. So since a lot of you feel that you have suffered so much, I've suffered so much watching the market go down for sale, I've suffered so much, right? Do not walk away without your reward. Okay, your reward is coming, and your reward is for every 1% of pain you felt going down, you're going to get 4.8% of rewards going up. It has happened historically, it will happen again. You just have to be there for it to happen, right? And remember that bull markets last 4.33 times longer than bear markets. The average bull market lasted 55 months, average bear market lasted 12.8 months. So again, for every 1 month pain you go through, there's gonna be 4 months of gains you're gonna go through, right? So like the market, look to the future. Don't look at what's happening right now. Look at where the puck is gonna go soon and position yourself for that. So let's take a look at tactical positioning. So does it mean that an investor or trader should buy right now, thinking that a bull market's coming? It really depends. So it depends on whether it's an investment or a short-term trade. So for investments, if you're taking a medium to long-term view, like 2 years, 3 years, 5 years, then there's nothing wrong with buying good businesses that are undervalued right now and taking a dollar cost averaging approach, which means you don't attempt to time the short-term trends because sure, it could go lower, but if you're averaging in, you know that over the long run, it will be higher, so it doesn't really matter anyway. But if you are looking at short-term trading, then obviously you do not want to go long right away because currently it is still on a downtrend, which means in the short term, it could still go lower. So the way to look at a market is in short term, medium term, long term. Short term, still going down. Medium term to long term, I'm more bullish, obviously, right? So if you look at the S&P 500, and let's take a look at the short-term time frame, and let's look at the daily candles, and you can see it is clearly on a downtrend. If you look at the moving averages, the 20 EMA, which is the red line, is below the 40 EMA, the blue line. So that's a short-term downtrend. The 50 moving average, which is a thicker blue line, below the 150 moving averages, still on a downtrend. So all the trends are still down, and you can look at the price action as well, which obviously is making lower highs and lower lows. So on a downtrend, if you're doing short-term trading, then obviously you still want to be short the market and not long yet. In fact, for me, in my trading, you can see that the moment we had this 90-degree drop, I went long. I bought the S&P using options. It went up, I took profit, and then I went short last week. If you take a look at my chat groups, you can see I posted this trade on the 28th of June, where I said, okay guys, I entered a bear put spread on SPY because based on price action, it looks like it's coming down, rarely on a downtrend. And I actually went short on Microsoft and Adobe as well. All right. So some people would think, hey, Adam, why are you going short? Don't you think Microsoft and Adobe are good companies? Of course, they're good companies. So in my investment portfolio, I'm buying, I'm holding. But for the short-term trades, I'm shorting. So you can do both investing and trading at the same time, where investing is you're buying, you're holding for the long term because it will go up eventually. But in the short term, if you see the trend is going down, you can take very short-term trades to make quick profits as it goes down slightly lower. So obviously right now you can see after this bounce, we went down a bit. So we may go down a bit more, or we may bounce up, hit the resistance and go down a bit more. You can't tell for sure. So short term, I'm still short here. And obviously, if you want to wait for a change in trend, you want to at least see the price action breaking this resistance, trend line resistance. You want to see a break of this line and then pulling back and being able to close higher than this trend line. So you want to see at least a higher high and a higher low breaking this trend line. And that would give you a clearer trend reversal where you could take more long trades, right? If you look at the moving averages, you can wait for the 20 EMA to cross above the 40 EMA, indicating the first signal of a change in trend. And later the 50 moving average sloping up, and finally 50 moving average crossing back above the 150. But by the time that happens, the price would have moved quite a bit up already. So usually once you see the 20 crossing above the 40, you could start to take some short-term long trades. So that's on tactical positioning. So at the end of the day, remember, you have to follow your investment and your trading plan. For investments, again, if it's a good business, nothing wrong with buying right now. As long as it's undervalued and hold it for the medium to long term, you will definitely do well in your portfolio. For short-term trading, wait for a clear change in trend, have your stop losses in place, your profit targets in place, and you trade it from there. So hope this has been useful, and I'll see you guys in the next video. Till then, may the markets be with you.